Another investment that I wanted to touch upon is this one here. Structured notes, structured products. There was a great article in AARP about these that outlines the risks really well. The thing is with structured products, is people ask, well, what is it? And the answer is, it's whatever the issuer wants it to be. Basically, all an investment company has to do is register the security with the SEC, and we're good to go. It can hold derivatives, it can be leveraged, it can hold futures, forwards, swaps, options, swaptions, anything. Now, of course, when people are pitched this product, what are they told? They're told all the benefits. There's extremely high returns. You can get in the market. You can really make a killing. They're safe, low risk, high yield. Oh, and they'll also use the words principal protected, which is, of course, nonsense because they're not FDIC insured or have no other type of insurance. If the issuer goes under, you've lost your entire investment is basically what happens. This article goes on to mention a few examples of people that have invested in structured notes, and I think they speak for themselves. And it's worthwhile to mention that structured notes are illiquid, just like those non-traded REITs I mentioned. They don't have an active market, and they basically exist only between you and the issuer. You can't go down to the exchange and sell them. You basically have to have full faith in the issuer. So when Lehman went down, all the Lehman structured products were basically worthless. So a few examples here. It says Charlie Rapogel wanted a safe investment for his 86-year-old mother and his mentally disabled brother. So when a broker, a friend he'd known since he was 9, suggested a low-risk, high-yield investment called the Principal Protected Note, the restaurant owner handed over $130,000, a third of his savings. And a little later in the article, within a year, he lost every penny he'd invested. There was no government-backed guarantee of his principal, and the underlying investment turned out to be unsecured bonds issued by Lehman Brothers, which, of course, collapsed in 2008. Of course, as expected, you'll have UBS spokesperson saying that the brokerage followed all regulatory requirements, well-established sales practices, and client disclosure guidelines in selling Lehman structured products to its clients. Of course. Because if you have an illiquid investment, which you push someone in to put in a quarter of their life savings, I'm sure all the disclosure guidelines were followed. I'm sure investors were told you can lose all of your money. It says, structured products now being sold to small investors in record numbers are so complicated that the brokers who sell them don't always know how they work. But unlike investors' returns, the broker's commissions are guaranteed. Kind of lovely how that works. Here's another example of Wall Street playing with investors. It's quite amazing how these kind of products, people buy it because it sounds great. The story is great. It says the sale of structured products keeps rising. In 2010, Wall Street firms and major banks sold a record-breaking $51.86 billion of the investments to U.S. consumers. Their pitch, low risk to principal and high yield. Their favorite customers, older Americans who are scared of outliving their money if it remains parked in low-yielding CDs and bonds, and often are desperate to find the safe, better-paying alternative. So it says, clearly Wall Street is targeting fixed income investors, most of whom are retirees seeking a steady source of income while guarding against any material loss of principal. And he says hundreds of older investors have been burned. Another example, a person in Michigan invested in Lehman notes through UBS for his family trusts and his 80-year-old mother. He expected, quote, a good solid return with minimal risk. Here's the best part. The broker implied that the notes were like U.S. Treasuries. I love that. I love that. His family lost $275,000. That's another example. Tricia Flanagan invested $200,000 in principal protected notes for her retirement in 2008. A real estate agent in South Carolina, this person had second thoughts when Lehman's financial woes made headlines, but her broker convinced her not to sell. She lost her entire savings. And I'm not bringing these examples up to scare investors or to scare people or, make them put their money under the couch. The point is that people are just being lied to, plain and simple, and it's not necessary. There are much more liquid investments that provide steady returns, and they really provide a better way to invest. It goes on to say, Louis Straney, a securities arbitration consultant in New Mexico, believes that structured products are Wall Street at its irresponsible worst. In my 3 decades of Wall Street experience, I've not seen any other product as absurdly destructive. So this article also compared the current state of Wall Street finance to the 1980s junk bond days. That's another investment that's currently being pitched to investors. Now, these structured notes are interesting in how they actually are structured. First of all, they cap your gains. So they put a limit on the amount that you can actually gain in the market. It says here in an example, if the index rises 41% or more, the investor's return is automatically slashed to 10%. How does that work? Well, if you invest in this security and it rises to anything under 40%, then you can make that gain. But God forbid, the market does really well and it goes up 41% or more, your return as the investor slashed to 10%. Who keeps the rest? The investment company. So if the market does okay, they'll be happy to hand it over to you. But if it does great, you're going to take a hit. Many structured notes are also callable, meaning that the issuer can force investors to redeem them before the return gets too high. So let's say you're on track to really make a killing. You know, you're going to make that 39% because you can't make over 40. You're going to make 39%. Oh, it's been called. And the company that issued that security is just going to take it back, give you your principal back, and they earned interest up to that point, and that's it. To add to the beauty of these investments, you are taxed at ordinary income rates, which are generally around 30%, instead of the more favorable long-term capital gains rate of 15% that is taxed on dividends, typically. And also downside protection. You know, a lot of people get into these investments because they want to have downside protection. They don't want to experience the downfalls of the market. So we already saw that you can't experience all of the upside. Let's take a look at the downside of structured notes. Many notes will shield your principal from stock losses, say up to 10%. But if the market falls by more than that, the value of your note could tank right along with it. What does that mean? So with structured notes, if the market falls 8 or 9%, you get your principal back. If it falls 11, 20, 30, or 40, you take the full hit. This is one of the most backwards investments that I have ever seen as far as putting the investor in the worst possible position. It's quite amazing that this is being put out there. So the market does really well, you can't participate. But the market does really badly, you're going to participate in all of that. And if you decide to redeem before these investments mature, then you're going to lose money as well. So how can you get all of these benefits of not being able to participate in upside and being able to participate in significant downside? Well, you'll pay a hefty fee, at least 3% of your investment. The article goes on to quote, "I've never seen a cheap retail structured note. Perhaps someday Wall Street will offer investors a structured note that's as appealing as they offer to their institutional investors. Until then, the recommendation here is to take a pass." And it's like anything else. You really have to evaluate the merits of everything that you're getting into, because even the word guarantee, the scariest word in the market is the word guarantee. You have to run as soon as you hear guarantee, and you have to run as soon as you hear complex. And structured notes have the benefit of both of those. So that's just something that investors should be aware of. Another article on structured notes was in the Wall Street Journal. This one was very good as well. I'll post the link up on my site. Consider one of UBS AG's return optimization securities with contingent protection. Sounds good enough, which was priced in July. Investors get 100% principal protection as long as the Standard & Poor's 500 index hasn't fallen more than 30% at the end of the product's 3-year term. If the index falls more than 30%, investors suffer all the losses. If the markets fall by less than 30%, investors get their principal back at the end of the product's term, which seems to be the only benefit. If the index rises, investors earn 1.5 times the upside up to a cap of 58%, which they get if the index is up 39%. Fees are 2.5%. So, first of all, to calculate the actual return that you might expect, I think you need at least a master's degree in finance, or if not a PhD.